Welcome back to the channel. My name is Derek Coffey and I'm the founder of FwP. And the entire point of the content that I put out is for you to reach financial independence, basically get you to the point that you no longer have to worry about money. Now, up to this point, all of the content that I have put out has been all about retirement and building a retirement plan. Now, I've put out content that goes over the basics of finance, but I haven't done a video where we put it all together into something that you can actually use. That's the point of this video. In this video, I'm going to walk you through the first 8 steps that I think you should take to get yourself on the path to financial independence. It's not easy. It's not going to happen quickly. But if you follow these 8 steps, you're going to lay yourself a foundation that you can truly build off of. Stay tuned. Now, before we get into these 8 steps, I want to let you know that at the end of this video, I will show you a free program that I have to help you implement these 8 steps. Yes, it's relatively elementary, but fixing your finances isn't that difficult as long as you understand the basics. So stay tuned to the end of the video, or hell, skip right to the end of the video. That way I can show you how you can implement these steps and make it a little bit easier on yourself. Step number 1 is going to be all about getting to know your money. Everyone knows where their money comes from. It comes from the job that you work, but not everyone knows where their money goes. You know you have basic bills that you have to pay every month, but then any money that's left over just gets spent. There isn't a designation for those additional dollars. So the first step towards financial independence is getting a handle on your money and ensuring that your money is going towards something that's only going to better you in the future. To truly get a handle on your money, you need to have a budget. I know, budgeting sucks. Nobody actually enjoys it. It's just like dieting. But unless you're willing to make a significant change with your money, you're always going to be worried about your money. You're always going to be worried about your financial situation. So the first step is getting a handle on your money. The easiest way to do this is to print off last month's statements, your checking account statement, any credit card statements, and start laying out where your money went. Categorize these transactions, put them into a needs category, a wants category, or even a savings category if you are actively saving, just so you know what your money is doing. What you have to understand is that your money is a tool. It is the tool that you're going to use to build towards financial independence. If you don't know what tools you have to work with, then you're never going to hit it. So take the time to get to know your money, lay it all out on paper. That way you can start planning for your financial future. Step number 2 is going to be all about conscious spending. I want you to become mindful of the money that you're spending and why you're spending it. You can lay out your transactions all you want and categorize them and continue overspending, but until you start reintroducing the pain of spending money, you're not going to make any significant change. Because we use debit cards and tap to pay and all other sources of payment instead of actually paying cash, we don't feel the pain of spending money anymore. So with step number 2, I want you to keep track of every dollar that you spend for a week. Note everything and categorize it. Now, on top of that, I want you to keep track of the times you didn't spend money just because you were paying attention. Say you didn't go out to dinner one night and decided to cook at home because you were consciously spending your money. You may have saved yourself $30 or $40. Maybe you skipped lunch once or twice a week and packed something from home. That could have saved you another $10 or $20. At the end of the week, add up all the times you didn't spend money. Maybe it's only $50 or $60, but if you multiply that by 52, all of a sudden you have $2,500 additional dollars that you can start putting towards your financial future. What you have to understand about money is that the small changes add up over time. You build wealth with compound interest, but compounding changes that you decide to make are what's truly going to put you on the path to financial independence. Step number 3 is going to be all about keeping your money. In step 1, you figured out where your money was going. In step 2, you reintroduce the pain of spending that money. In step 3, you're actually going to find ways to save on the money that you spend. Now, for most people, the biggest wants spending, or where they're wasting the most money, is going out to eat. Now, I don't want to discount the convenience of going out to eat, especially if you have children or if you live a very hectic lifestyle. Being able to go somewhere, have someone prepare the meal for you, you eat it and leave, not have to worry about any of the cleaning or any of the work that went into that meal is very convenient. But what you have to understand is that you're paying for that convenience. If you go through your monthly transactions and you're spending $800 a month going out to eat, whether that's for dinner and or lunches, then if you cut that in half, you all of a sudden have $400 each month that you can use towards your financial future. The next thing I want you to look for are your unused subscriptions. If you have a bunch of different streaming services that you're paying for and you only use a handful of them, then get rid of the ones that you do not use. Streaming services at a minimum are going to run $10 to $15 a month. If you have 5 of them and 3 of them you're not using, that's an additional $45 that you could be using towards your savings. And speaking of streaming, I want you to look at your cable and internet options. If you have a cable package through one of the major brands, then you're probably overpaying for the channels that you actually use. If you have a 300 channel lineup and you're only using 10 to 15 of those channels, then look for a streaming option that only offers the channels you're going to use. You could save a significant amount of money doing this. Now with internet, if you're not a gamer and you're only scrolling on social media or checking emails, then consider reducing your internet speeds. You could leave Comcast or any of those major brands and use a T-Mobile in-home internet provider. Verizon offers the same thing, and they run roughly $50 a month. If you're able to cut out the majority of your cable package as well as only pay $50 a month for the internet speeds you actually need, you could save yourself a significant amount of money. And this is just 3 areas. There are plenty of others that you could look into, but these are the top 3 and the most easiest for you to change. So with step 3, focus on keeping your money. You're attuned to what your money is doing at this point. So make sure you're cutting back where you can. The 4th step is all about your emergency fund. And I'm not talking about the emergency fund that all of the experts want you to have. I'm talking about a very basic emergency fund. This basic emergency fund is $1,000 per person in your household. And the whole point of this is to buy you time when an emergency happens to make sound financial decisions. If you blow a tire and it's going to cost you $300 to fix it, having $1,000 set aside in your savings is going to help you sleep better at night because you can just pay for it. If you didn't have that money setting aside, then you're probably going to end up putting it on a credit card and paying 20% interest. So step number 4 is all about building out that basic emergency fund. If it's just you, you need $1,000 in the bank. If you're married, it's $2,000. If you have 2 kids, that's $4,000. But what that $4,000 is going to do is it's going to buy you the time you need to make the right decision, if not cover the emergency completely. So where's the money going to come from for you to start building out your basic emergency fund? Well, if you have to set aside $4,000 in cash, it's probably not going to happen very quickly, but I want you to at least have a plan. What we're going to do is we're going to take the money that you found between steps 1 and 3, and we're going to take 2/3 of that amount and automatically draft it into your savings account. That remaining third is for you to enjoy. If you've gone through steps 1, 2, and 3, you have changed a lot about your finances. You put in a lot of work that you normally wouldn't have. So take that extra third and start enjoying it a little bit. If you've cut back on your hobbies, then re-engage a little bit. If you've cut back on your dining out expenses, then maybe take yourself out every now and again as an additional treat. But use that extra third on something you enjoy doing. Now, don't get too comfortable using that third because we are going to use it later on. But for now, enjoy what you have worked hard for. Step number 5 is all about your home and auto insurance. When it comes to financial planning, you have to protect whatever it is you're building. The first step is through your home and your auto insurance. If you're driving around in your vehicle, that's when you're most exposed to a loss because it's not just you on the road. You have to worry about everyone else that's driving around you. So if you don't have the proper amounts of liability insurance or the proper amounts of bodily injury protection, then you could leave yourself overly exposed to where everything that you've built can be taken away from you. The same thing could be said about your home. Your home is the single largest purchase you're ever going to make. So not having the proper amounts of coverage on that home or your personal property within that home just doesn't make any sense. So with step number 5, we're going to start protecting what you're building towards. You need to call your insurance provider and ask them for a copy of your declaration sheets. And what these are is an outline of what your policy covers. Once you get those deck sheets, you need to take them to 2 or 3 different insurance agents and get them to quote your coverages. The purpose of this is to ensure that you have the coverage amounts that you need. What we're looking for are any gaps in your current coverages. Now, what I don't want you to do is to sacrifice coverage just to save money. You may end up needing to pay a little bit more every single month to have the coverages that you need. But without those proper coverages, you could leave yourself overly exposed, and it's going to throw off everything that you're working towards. This is going to lead us into step number 6. Step number 6 is all about your life insurance. If you don't have any life insurance, please get some. The whole point of the life insurance is to protect you and your family from you passing away too soon. Now, there are a bunch of different types of life insurances that you could use, but the most common are going to be whole life and term life insurance. When it comes to whole life insurance, you should have enough coverage to dispose of your body the way that you wish. Whether you want to be buried, cremated, whatever your wish is, you should have enough whole life coverage to cover that. This could be $25,000 or $50,000, but something that's relatively cheap depending on your situation. The rest of the coverage that you need needs to come from term insurance. Term life insurance allows you to buy a large amount of coverage for a much cheaper premium than if you get a whole life policy. When it comes to the amount of term coverage you need to have, there are 2 ways to go about calculating that. The first of which is having enough coverage to pay off your debt. So if you have a house, a car, credit card, maybe a student loan or 2, you need to have enough term life coverage to wipe out all of that debt. That way your beneficiaries aren't left making those payments. Now, the specific term that you need, or the number of years that you should have that coverage, is whatever's going to cover the longest remaining debt. So if you have a mortgage on your home and there's 25 years left on that mortgage, then you need to have a 25-year term. That way, if you pass away before that 25 years is up, all of that debt is going to be wiped out and your wife and your children have nothing to worry about. Now, that's going to be the cheaper option of the 2. If you decide to go with the second option, you're probably going to have to pay a little more because you need a little bit more coverage. But with option number 2, we're looking at replacing income. If you bring home $40,000 a year after taxes and you would prefer that your spouse and your children continue receiving that amount of money, you need to multiply that by the number of years you want to cover. So if you wanted to ensure that they kept receiving that amount of money for the next 25 years, you're going to take the $40,000 net, you're going to multiply it by 25, and you need $1 million of term life coverage. The term works just the same. You still want your term to equal that longest remaining debt or whatever's going to get your youngest child out of the household. So if you have a 5-year-old and they're your youngest child, then you want to have at least a 15-year term if that's longer than whatever debt you have remaining. Again, it is going to be the more expensive option, but it is going to ensure that your beneficiaries' lifestyles don't have to change. Step number 7 is all about your credit score and your debt. The reason your credit score is so important is because it directly determines how much it's going to cost you to borrow money. Whenever you purchase a car or a home, the lender is going to pull your credit score. The higher that score is, the lower the interest rate you're going to pay, the cheaper it is for you to purchase that asset. The lower your score is, the higher the interest rate, the more it's going to cost you to purchase that asset. So keeping your credit score as high as you possibly can is only going to benefit you. Now, when it comes to pulling your score, the 3 major bureaus offer you 1 free credit report each year. So go to each of their websites, Equifax, TransUnion, and Experian, and request your free credit report. This is going to tell you not only what your score is, but it's also going to let you know what's affecting your score. If you haven't had a handle on your money, then you've most likely missed payments or been late on some of those payments, and that's negatively impacting your score. Now that you have a handle on what your money is doing, you can start making those payments on time and improving your credit score. With your credit score comes the conversation of your debt. And the debt that I'm specifically focusing on is anything with an interest rate over 8%. If you have any debt with an over 8% interest rate, I want you to sort all of it by balance, from smallest to largest. Any additional money that you have each month, I want you to add it to the minimum payment of the lowest balance debt. Once that debt's paid off, we're going to snowball that until all of your 8% plus interest rate debt is gone. Where's that money going to come from? Well, if you remember from week 3, we had an additional third that I said that you could go and enjoy, but not get used to it. That third is what we're going to use now to snowball your debt. So again, all of your debt over 8%, sort it from smallest to largest balance. Add that third to the minimum payment of the smallest balance and snowball those payments until all of that high interest rate debt is gone. What you have to keep in mind is that debt equals stress because it's something that you have to pay. It constantly hangs over you until that debt is gone. So if you have a plan in place and you start paying off that debt, then you're going to start to lower your stress levels when it comes to your money. Now, the final step in all of this is saving your money, actually putting your money to work for you. That way you can achieve financial independence. Now, I don't want you to save this money blindly. I want you to save it as efficiently as possible for you and your specific situation. There's not a one-size-fits-all approach, but for a lot of the people that find value in my content, they are going to follow somewhat of a similar path. The first step is going to be building up that emergency fund, at least that basic emergency fund. After that, we want to get the full company match if you're eligible for one. If you were eligible to participate in a 401k and you're able to get a 5% dollar for dollar match, then you need to be contributing 5% of your salary to get that 5% match from your company. If you make $50,000 a year, you put in $2,500, your employer also puts in $2,500. If you're not putting in the money on your part, then your company doesn't have to put any money in your account. So why leave that money on the table? Your employer expects everything out of you, so you may as well get everything you can out of them. So get your full company match. After that, any additional money you have left over, we're going to pile that on to your high interest debt. We've already built a plan for that in step 7, but if you have any additional money left over, you're going to start paying off that high interest debt. Once you have all of that debt that has an 8 or more % interest rate on it paid off, that's when we're going to focus on the Roth IRA. Now, the reason we want to focus on the Roth is because that's what's going to build you a tax-free source of income when you retire. Unlike a 401k where you're putting money in on a pre-tax basis and then have to pay taxes when you take it out, the money you put into a Roth goes in on an after-tax basis. That money gets to grow tax-free just like it does in your 401k, but when you turn 59 and a half and the account's been open at least 5 years, you can withdraw all of that money without any income taxes. So just by working through those 4 steps, you could put yourself in a position to have a couple of $1 million over the next 30 years. But I want you to save your money efficiently. Don't just save it blindly. Look into each of the account types that are available to you and ensure that it's going to work for your specific plan. So those are the 8 steps that are going to get you on the right path to financial independence. Now, you may be thinking to yourself, how in the world am I going to keep track of all of these things? Well, as I stated earlier, if you made it to the end of the video, I have something free for you. On my website, which there will be a link in the description of the video, you can download all 8 of these steps broken out by week. Now, some of them are going to take an entire week. Some of them may only take you a couple of hours. But if you work your way through this, then you're going to be in a much better position when it comes to your money than you were when you started. And it also just so happens that we're just under 8 weeks from the beginning of 2025. And I know that you may not be too inclined to really dig through your money this close to the holidays. But if you're able to do just a few of these steps, then it's going to allow you to hit the ground running in 2025. In addition to this download, you're also going to have access to the financial planning sheets that I have available. In there, it actually gives you a place to do a month of your transactions. It's also going to give you a sheet to keep track of your conscious spending. In that sheet, you're going to put in there every single time you spent money. But what I also want you to keep in mind are the times that you didn't spend money. I want you to annotate it. So if you decided not to go out to dinner and it saved you $50, put $50 in that column. If you didn't go to lunch and it saved you $15, put that in that column. And then at the end of the week, it's going to tell you how much money you saved by consciously spending your money. Again, it doesn't seem like a lot, but when you multiply it by 52 weeks, it adds up very quickly. The final sheet that you're going to have access to, at least with the free version, is the financial dashboard. And with that, it's going to have a layout of all of your income, all of your expenses, any of your savings, and your miscellaneous spending. It's also going to give you options to fill in any type of accounts that you have money saved in, as well as any monthly contributions that are going into it. It gives you a place to lay out all of your debt and sort it by balance if it's over 8%. All of these things can be laid out in that sheet. What I do want you to keep in mind is only fill out the things that are in yellow. If it's not yellow, do not fill it out because there's probably a formula attached to it and it's going to screw it up. Now, if you wanted to have the additional sheets like the true emergency fund estimator, not just the basic, or the life insurance estimator, or the income replacement estimator, which I'll go over that in its own video, then you can become a member of the site. It's $7.99 a month, and it gives you access to all of the resources. But my hope is that with this video, it at least gets you on the right track. It at least gets you moving towards a better financial life, ideally financial independence. You're not going to be able to accomplish everything in 8 weeks if your financial situation is a complete mess. If you don't have a very complicated financial picture, then getting it right is only going to take a couple of weeks. But if it truly is a mess, it may take you 3 months. It may take you 6 months. But working through these 8 steps is what I feel is going to get you on the right path. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that is wanting to get right with their money, then send this video to them. Maybe this system and this program will help get them on the right track. But I thank you so much for tuning in. I'll talk to you soon.